Good morning, guys. It is Tuesday, August 27th, 2024. This Bathrobe business got the coffee and I got the news. So it's been a few days since I posted. There hasn't been too much talk in the market. There hasn't been too much news in the market to report, other than, of course, Jerome Powell signaling that he's going to be cutting interest rates. I'll share this screen with you guys, but essentially it's saying what we already knew, that he was going to be cutting interest rates sometime in September. One sec. There it is. Nothing fancy. We all know this is coming. Now, he hasn't yet said how much it is. Everybody's speculating. Is it going to be a quarter percentage? Is it going to be half a percentage? We don't know yet. It's going to be at the September meeting, but he is signaling that it's coming. His justification for it is weakness in the labor market, which I argue is not as weak as it seems. I still say that inflation is a bigger issue than what the metrics are leading on. Now, where do I get this justification? Well, we've looked at multiple assets that have increased in value, and I'd like to share another one with you right now. So this is actually coming from our local KSL, that a record number of U.S. homes valued at over $1 million. So the article is long. It talks about a lot of different factors, but I want to report on one specifically. Nearly 1 in 10 U.S. homes are worth $1 million or more. That's about 8.5%. Pre-pandemic, it was 4%. But even from a year ago, let's say that the pandemic inflation was just a one-time occurrence. Even from a year ago, it was 7.6%. So despite the fact that homes have incredibly high interest rates, the prices were already incredibly high. There's still an inflationary pressure here that increased at a full percentage point over a year. A full percentage point we're talking about in home values. We've also shared with you guys, again, stock prices. We've shared with you guys increases in wages. I've shared with you increases in commodities like gold, one of my favorite metrics, crypto as well. I do think crypto is a bit of a financial product in the fact that it reacts heavily to what happens in the market. Like when the stock market plummeted 1,400 points, it went down from 60,000 to 50,000. However, I still think it does show some inflationary trends as well. The fact that Bitcoin is at record highs isn't just accounted for by the ETF. I think that's accounted for with the fact that inflation is still very high. Now, this number is also exacerbated by the fact that we've seen actually massive sell-off of corporations from the housing market. So what I mean by that is Airbnbs. Everybody purchased them in 2020 trying to make a buck, and then realized it was too expensive. There was a surplus of people doing it on Airbnb. There was a lot of dissatisfaction with a lot of the options. So there was a huge shrink in the market, and it decreased drastically. Lots of people sold off their homes. Similarly, we talk about institutional investors holding homes and renting them out. That has steadily decreased with both private equity and venture capital, and many of them have gone to sell off those homes. In fact, a lot of the surpluses that have originated in places like Texas and Florida are a result of that, of these institutional buyers liquidating their asset. So despite the fact that there is actually a huge influx of supply, quote unquote, into the market, the prices still continue to rise. This is why I don't think it's a good idea to cut interest rates. Lastly, I'm going to share something with you guys that I haven't actually, well, I talked about it on the channel, but I bring it up rarely, is the issue with labor. The fact that we are in a demographic collapse. Now, a lot of people say this is a problem for the future, but I think it's a problem for right now because I do recommend you check out Peter Zion. I don't agree with him on 100% of everything, but I think he's absolutely spot on when he talks about demographics, because demographics, it does determine where the economy is headed and where it's been. And he talks about how the fact that the subsequent generations are smaller than boomers. So as boomers retire, there's not enough extras, there's not enough millennials, there's not enough Zoomers to replace them. So just from a demographic standpoint, you're going to see increases in the cost of labor because you have to pay more for a quality employee than you did just 20 years ago because the boomers are leaving the market. So you're going to see an inflation in wages. You're going to see an inflation in prices just based off of that fact alone. So I don't think we're going to be in a market where you could just say, oh, we'll have low inflation and low interest rates. Now, there is an argument you can make for that. It's a financialized argument, the way you structure the economy, but I still don't think it escapes the inflation issue. You could say that we'll be able to bolster the economy with low interest rates despite inflation, but you have to accept inflation as a factor and the fact that you won't be able to control it. So I think that's something we have to anticipate, is that inflation is just going to be baked into the system for the next 20 or so years as the economy kind of restructures with a large portion of the population exiting. We will have to come up with methods of alleviating that through, name the structure, outsourcing, offshoring, AI, whatever it is. But there's going to be an inflationary pressure that's going to exist for the next 20 years as the boomers leave the economy. The spending changes because boomers will be withdrawing a lot of their high risk assets into low risk assets. So investing is going to change in that regard as well. We forget that the boom in Wall Street, the boom in Silicon Valley, coincides with boomers' investments and in entering the market. That's not a coincidence. So I think that's going to be echoed as well in how things are invested in the near future. I do want to share one last thing on inflation before we move on to the next subject. And that's this article, which is kind of funny, which is increase in the sausage index. So increase in sausage demand could be warning signal of the economy. So what this is one of those funny indexes, the McDonald's inflation gauge, the Burger King, estimator, or whatever. There's always some new trend that says that this one metric helps determine the health of the economy. Now, I think a lot of them is silly, but I think there is some weight to these stories. So there's been a modest growth in dinner sausage category for one producer, according to the Dallas Federal Reserve. This underscores the trend of shoppers for opting for cheaper products, pulling back on spending altogether as cumulative inflation bites into purchasing power. So I think this is another sign that inflation is actually still much higher than what is being estimated and much higher than how the Fed is calculating it. Essentially, the article is saying that people can't afford the more expensive products. They're opting for sausage. Again, I think that this little gauges like this outweigh the actual issue because I think they affect a particular group in the economy. I don't think they're an overall market trend. However, I do think we should look at them. And I think this isn't. So, in other words, I'm going to be a bit conniving here and say that, oh, this proves my point. But I think it does prove a point. I think it does prove the fact that it is an increase in inflation much more than is being reported. Because I think other than just eggs and milk with the grocery store, a lot of times inflation bears its teeth in other sectors of the economy. So when you finally get to the grocery store, even though the eggs and meat might be less expensive, you've already been hit by inflation before you ever walk through the door. We've talked about, obviously, car insurance, and I've talked about how that's a leading indicator, and I've shown you guys why that's a leading indicator and not a lagging indicator. Cars, homes, rents, etc., everything is up. And because of that, by the time you get to the store, it really doesn't matter if the cost of sausage has decreased by 50 cents. You've already been hurt by inflation before then. Last couple of stories I'm going to talk about. These two kind of are going to be rapid fire. I just think these are interesting in regards to what's happening globally. I try to report domestically, but I think this does affect all markets. So the first is that Canada is imposing 100% tariff on all Chinese imports. I should say Chinese-made electric cars, exactly signaling what the United States did. Europe did come out with heavy tariffs, but nowhere near 100%. I think they settled around 20. And also, last story I'm going to share is BMW overtakes Tesla in Europe EV sales for the first time. So Tesla's really struggling. I just think these are both interesting stories from the facet of EVs. I think that the EV market is just, despite the fact that it is in quote unquote collapse, as a lot of people say, because the prices have fallen so much. I think it's an overproduction issue. But I think it's just interesting that it's become such a major story that the tariffs are so high across the board that they're competing over EVs more than they are competing over traditional auto sales. So just side note. Last story I want to talk about is a local story. So this is one that is near and dear to my heart. You guys know I've talked about this subject multiple times. What Utahns think about raising taxes to help pay for downtown Salt Lake City. I have real issues with this article. So for those that know, for those that don't, the Smith Group is planning to revitalize the Delta Center, and they are planning to bring the NHL stadium into downtown as well. So they want this big sports complex, and I've talked about before how they're going to be raising sales tax 0.5% in order to generate this amount. I've talked ad nauseum about why this is a bad idea. My previous videos, actually, I think one of my most successful videos was about this very subject, where a lot of you responded with essentially a complete agreement with me that this is a bad move for the state of Utah because it's a major handoff, a major wealth transfer from the rich to from the poor to the rich. I don't know how else you could take that because just to summarize, I think there's a very nice paragraph here in this article I want to share with you guys. Right here. So essentially, the tax hike is anticipated to generate 1.2 billion over a 30-year life agreement, 900 million of which will go to the Smith Group. So essentially, they're just giving $900 million to a billion-dollar corporation. Wouldn't that be nice if you wanted to? And why are they doing this? Because 525 million is going to go to remodel the 33-year-old Delta Center, and 375 will go into that just district that they're creating. So isn't that great? Like next time you want to, make an addition to your house or do a remodel, all you got to do is just go to the state of Utah and be like, hey, can you raise taxes on everybody else and then just give me that money? Because I really need to, revitalize my house. And when I do that, it's going to make the overall area much better because my house is going to look so good. It's going to look so good that the real estate values around it, people will be like, wow, if they live next to that house, then this must be a good neighborhood. That's essentially the justification for these ridiculous corporate welfare programs where they give you a vague notion of, oh, this will improve our economy without any justification. And all it does is price locals out of the economy, hand off massive wealth from the poor to the rich, and create massive wealth inequality. There's no other way to take this. And this is the direction that Utah is headed. Unfortunately, this is the direction that all states head whenever they start to grow. In that video that I posted, I got into a I shouldn't say major argument, but I got into an argument with someone in the comments section claiming that these projects help because he lives in, I believe it was Minnesota, and they have an NHL team, and they have a basketball team and a baseball team, et cetera, et cetera. And then you look at the quality of life there, and you measure every metric from affordability to housing costs to education. Everything is worse off. Everything is worse off. So these ridiculous notions of that it helps the community, it doesn't help the community by any noticeable metric. All it does is transfer wealth from the poor to the rich, improve the lives of the rich because now they have $900 million to do whatever they want, and the local economy and the local residents suffer. So this is one of the reasons why people go socialist. Okay, I for those new to the channel, I'm not a communist. I'm not a socialist. That flag is more of a novelty. But when you see people, when there's articles out there like young people believe in socialism, this is crazy. This is why. It's stupid crap like this. This is why people go communist and socialist, because they can't afford to buy a home. They can't afford to buy groceries. They're buying sausage instead of whatever else. But billionaires are getting 900 million off of their backs. I would go communist too. I don't think anyone wouldn't. This poor Milton Friedman would be waving that communist flag. So that's it. That's all I wanted to talk about today. This massive wealth inequality and how the Smith Group is stealing our money. I hope you guys have a productive day. I hope you don't steal anyone else's money, and I'll see you guys tomorrow.